An event has occurred that could shift the balance in the world of technology. Trump's team has revoked the special waiver for TSMC, the very exemption that allowed the company to supply U.S. chip-making equipment to China without restrictions. Starting in December, every shipment will require separate approval from the U.S. government. The same rules now apply to Samsung and SK Hynix. The consequences extend far beyond Asia. Supply chains in Taiwan, South Korea, and even Europe are slowing due to new costs and delays. While Washington sinks deeper into bureaucracy, Chinese manufacturers like SMIC are expanding capacity, and Beijing is accelerating its progress in the artificial intelligence sector. And as the chip war escalates, another crisis is flaring on the horizon. U.S. Treasury bonds are tumbling. Yields on 30-year notes have once again approached the 5% mark. That means falling bond prices and rising costs for mortgages, business loans, and government debt. Investors around the globe are dumping assets, spooked by record budget deficits, shaky policymaking, and even court rulings that could wipe out billions in tariff revenues. Taken together, the picture looks grim. America is pressuring its allies, China is gaining ground, and U.S. finances are buckling under the strain. So let's unpack what's happening. Last week, Washington revoked the special waiver for TSMC, the arrangement that allowed the company to freely supply U.S. equipment to its plant in Nanjing. Starting December 31st, every shipment will need separate licensing. Where once there was streamlined and predictable trade, there is now a bureaucratic maze and months of waiting. The delays won't just hit China, but also America's closest partners. And this is happening just as China is accelerating its AI market. Companies like DeepSeek are already rolling out autonomous AI agents that rival OpenAI. Their success is visible in real-world products. But instead of striking directly at Beijing, Washington is dragging its own allies into the fight. Plants in China that once operated normally are now facing delays not because of Chinese restrictions, but because shipments are stuck in U.S. bureaucratic queues. Take TSMC's Nanjing plant, for example. On paper, its contribution to revenue may look modest, but the risk isn't in accounting numbers. If a license is delayed, production simply stops. The same uncertainty now looms over Samsung and SK Hynix. Their main problem today isn't demand, but whether the tools they need will ever arrive. In effect, these companies are cornered. Either submit fully to Washington's rules or lose control of their supply chains. And this is where frustration is building. While TSMC and Samsung wait for approvals, U.S. firms like Nvidia continue doing business in China and making money. Their partners suffer losses, while Washington looks as if, under the pretext of national security, it is really reshoring investment and production back to the U.S. But this approach carries risks. By forbidding allies from operating in China, Washington may trigger the opposite result. Domestic players like SMIC and Huahong will be forced to ramp up capacity quickly, fill the gaps, and seize market share. Instead of slowing China, such a policy risks accelerating its technological independence. Once Beijing reaches that level, stopping it will be impossible. This is not just tough rhetoric. It is a move that could fracture global supply chains, strain relations with allies, and give China the very advantage it has long sought. Now let's look at where Washington wants to take this battle next. After pressuring allies in Asia, the Trump administration is actively bringing chip production onto American soil. Arizona has been chosen as the center of this strategy. TSMC has pledged to invest up to $165 billion there, building 6 sites, from advanced chip fabrication plants to packaging and research centers. To support the project, Washington is allocating $6.5 billion in direct grants and another $5 billion in loans under the CHIPS and Science Act. On paper, it looks like a perfect solution, bringing the world's key company closer to home, but beyond the headlines, the scale of the task becomes clear. In the second quarter of 2025, TSMC controlled just over 70% of the global contract chip manufacturing market. For every $10 spent worldwide on chip production, $7 went to TSMC, and these are no ordinary chips. The company produces the processors behind artificial intelligence, smartphones, cloud servers, and supercomputers. So when Washington demands that TSMC replicate this capacity in Arizona, it's not just about moving a few factories. Essentially, the US wants to recreate from scratch the heart of the entire global technology ecosystem, and Arizona is already showing just how difficult this task is. B21 was supposed to produce chips using 4, 3, and even 2 nanometer technologies, the most advanced manufacturing processes in the world. But this requires not only buildings and equipment, but also top-tier specialists. Estimates suggest the US will need to train hundreds of thousands of new engineers to operate the factories under construction, yet such talent is in short supply domestically. Due to delays, TSMC has had to bring engineers from Taiwan to train American staff, sparking political debate and local frustration. The project has already missed its planned launch in 2024, and the problems are not going away quickly. Trump's dream of rapid success is colliding with harsh reality. Building from scratch the ecosystem for the most advanced technology on the planet is far more complex than slogans suggest. Meanwhile, China is moving in the opposite direction. Companies like SMIC and Huahong are steadily expanding capacity within the country. Beijing has spent years preparing for a potential disruption of global supply chains, investing billions of dollars to ensure self-sufficiency. And now, that preparation is beginning to pay off. The paradox is that the US may suffer more if chip flows are disrupted. Washington still depends on imports, while Beijing is steadily reducing reliance on external suppliers. And while Washington struggles with factories and supply chains, the battle for artificial intelligence is accelerating even faster. For the US, this is not just a technological rivalry. It is about protecting the tools that define economic power and military superiority in the 21st century. Chips provide the hardware, but the other half of the equation is software. At the center of this race are large language models, which have already become indispensable in science, business, and defense. For now, the global benchmark remains ChatGPT from OpenAI. Its systems are stable, tested, and implemented across various industries. But in recent months, China's DeepSeek has been closing the gap at a speed few expected. By early 2025, Washington had officially warned, the US advantage is measured not in years, but in just a few months. And it's not only about technology. Despite billions in investment, the business model of American AI startups has proven extremely fragile. About 95% of companies shut down just months after launch, burning cash without achieving sustainability. China, on the other hand, is delivering results. DeepSeek R1 and V3 models, built on roughly 2,000 Nvidia GPUs with budgets of several $1 million, have reached levels of reasoning and programming comparable to, and in some areas exceeding, the latest version of ChatGPT. Their efficiency is striking, achieving world-class results with only a fraction of the resources. This momentum has already expanded into mass usage. In January, the DeepSeek app shot to #1 on the American App Store, surpassing ChatGPT in downloads. This was not just symbolic. It demonstrated that Chinese platforms could capture the market even at the very heart of the US. Such success alarmed Washington. OpenAI openly stated, DeepSeek's low-cost model has the potential to reshape the global AI landscape. If American models are perceived as expensive, slow, and cumbersome, while Chinese models are fast and cheap, the balance of influence could shift far sooner than expected. In this AI race, one company is particularly vulnerable: Nvidia. Its graphics processors are at the core of the modern AI revolution. Both OpenAI's GPT and China's DeepSeek rely on these chips. They are the engine that allows language models to grow and function. Without Nvidia hardware, today's breakthroughs would simply halt. Therefore, every new decision coming from Washington lands directly on the desk of Jensen Huang, Nvidia's founder and CEO. The stakes for him are enormous. He has repeatedly called the Chinese AI market a $50 billion opportunity. This is not just revenue, but the foundation for Nvidia's long-term growth. Losing this sector would impact not only financial statements, but tens of thousands of jobs, slow American innovation, and weaken the US's influence in one of the century's key technological races. The overall picture is clear. The US wants to build a new global electronics hub at home, but faces talent shortages, delays, and enormous project costs. China, by contrast, is strengthening its own capabilities and rapidly catching up in AI. The balance of power is shifting before our eyes, and the advantage that yesterday seemed indisputable could vanish within months. The stakes in this race are not just corporate profits, but the future of global leadership. To keep up with the developments, subscribe to the channel and turn on notifications. See you in the next video.